Welcome back, students and scholars. In this episode, we continue Accounting Standards Codification Topic 250 and focus on accounting estimates and prospective treatment. Estimates are not a weakness in accounting, they are a necessary part of financial reporting because accountants often deal with future benefits, future obligations, recoverability, useful lives, bad debts, warranty costs, and many other uncertain items. The important question is not was there an estimate? The real question is did new evidence change a reasonable estimate? If yes, ASC 250 gives us a very important rule. Update the accounting going forward, but do not rewrite history. Why do estimates change? Because reality keeps sending new evidence. A machine may perform better than expected. Customers may pay slower than expected. Warranty claims may rise after a product issue becomes visible. Market demand may fall and affect inventory recovery. An estimate that was reasonable when made can become outdated later. That does not automatically mean someone made a mistake. It often means management now has better information. ASC 250 treats that as a normal professional behavior. Good accountants do not worship old estimates. They update estimates when the evidence improves, while keeping the proper accounting treatment clear. Let us see the learning path for this lesson. First, identify whether the item is actually an estimate, not a fixed contractual number. Second, check whether new information or changed conditions are driving the revision. Third, apply the change prospectively, meaning current period and future affected periods only. Fourth, avoid restatement because prior financial statements are not reopened for a normal estimate change. As we move through examples, keep this rhythm in mind. Estimate, new information, prospective treatment, no restatement. It is simple, but it is also one of the most commonly tested and commonly misunderstood areas of ASC 250. A change in accounting estimate is a revised view of an existing asset, liability, or future accounting pattern. On the asset side, it may involve useful life, salvage value, impairment assumptions, inventory recoverability, or allowance for doubtful accounts. On the liability side, it may involve warranty obligations, environmental remediation, pension assumptions, or legal contingencies. The definition is broad because estimates appear everywhere in financial statements, but the core idea is consistent. The carrying amount or future allocation changes because better evidence is now available. The estimate adjustment changes accounting from now onward. It does not go backward and edit prior periods. A critical distinction is this. Usually, the estimate changes, not the accounting policy. For example, if a company revises useful life, the depreciation policy may still be straight line depreciation. What changed is the expected period of benefit. If a company increases its warranty liability, the policy of accruing warranty costs did not change. What changed is the expected cost of future claims. This distinction prevents misclassification. If students confuse estimate changes with policy changes, they may incorrectly choose retrospective treatment. So keep the question sharp. Did the company change the rule or did management update the number used inside the rule? The new information test is the heart of this topic. Ask one question. Did the revised number come from evidence that was not available or not reasonably knowable when the original estimate was made? If a physical inspection now shows that equipment will last longer, that is new information. If actual warranty claims over several product cycles show a different failure rate, that is later experience. If a customer market weakens after year end, that is a changed condition. If demand forecasts now show slower inventory movement, that is a revised expectation. New evidence points toward estimate change. Old available facts that were ignored point toward error. This slide gives us the important signal test between estimate change and error. If the facts are new, later, or freshly developed, we are usually in estimate territory. If the facts existed earlier but were ignored, misused, or calculated wrongly, we may be in error territory. The accounting treatment changes dramatically. An estimate change is current and prospective. An error may require restatement. So, when you face a question, do not ask only, did the number change? Ask, what information existed when the original number was recorded? That one question can save you from choosing the wrong accounting treatment. Estimate changes appear everywhere. Receivables may require a revised allowance when customer credit quality changes. Inventory may need adjustment when demand falls or selling prices decline. Depreciable assets may need revised useful life or salvage value after inspection or usage data. Warranty obligations may change when actual product failure rates differ from original assumptions. Students often think estimate changes are only about depreciation, but that is too narrow. In real financial reporting, estimates are like quiet background machinery. They may not always be visible, but they are working in almost every major account category. Now we reach the core treatment rule: current and prospective, not backward. A revised estimate affects the current period, and if it affects future allocations, future periods too. Prior periods are not restated. Why? Because a normal estimate change does not mean the prior estimate was wrong when made. It means better evidence has arrived now. Rewriting prior period statements would send the wrong message. It would imply that management should have known the future earlier. Accounting is serious, but even accountants do not get time machines. ASC 250 keeps prior periods intact and updates the accounting going forward. Some estimate changes affect only the current period. For example, if a company increases its allowance for doubtful accounts based on updated credit data, the additional bad debt expense is recorded now. If inventory is written down because current market conditions reduce recoverable value, the write down is recorded now. If a warranty liability increases because current evidence shows higher expected claims, the adjustment is recorded now. Once the balance is updated, there may be no separate future allocation from that revision. The full effect lands in the current period because the estimate relates to the current balance sheet position. Other estimate changes affect both the current period and future periods. Depreciation is the classic example. When useful life, salvage value, or the pattern of benefit changes, we do not go back and restate old depreciation. Instead, we take the carrying amount at the date of revision and allocate it over the revised remaining life. The current year receives the first adjusted depreciation charge, and future years receive the revised charges after that. This is why estimate changes are called prospective. The accounting walks forward from the revision date. It does not march backward into already issued financial statements. Let us use Vela Machines, a fictional manufacturing company, for a useful life case. Vela bought equipment for $120,000. The original useful life was 6 years and the original salvage value was $12,000. The company used straight line depreciation. After 3 years of use, a professional inspection shows that the machine can operate longer than expected, but with a lower estimated salvage value. This is a very common real world estimate change. Better technical evidence arrives after the asset has already been used. Now we calculate prospectively from the carrying amount at the revision date. Before calculating the new depreciation expense, we first need the carrying amount. Original cost is $120,000. Original salvage value is $12,000. So the original depreciable amount was $108,000. Over 6 years, straight line depreciation was $18,000 per year. After 3 years, accumulated depreciation is $54,000. Therefore, the net carrying amount is $66,000. That 66,000 is our starting point. Notice carefully. We do not restate the earlier $18,000 depreciation charges. Those prior entries stay as recorded. Now we calculate the new annual depreciation. The carrying amount is $66,000. The revised salvage value is $8,000. So the remaining depreciable amount is $58,000. The revised remaining useful life is 5 years. 58,000 divided by 5 gives $11,600 of depreciation per year going forward. The annual depreciation drops from 18,000 to 11,600 because the machine is now expected to provide benefits for a longer remaining period. Again, no prior period adjustment, no retained earnings restatement, and no backward correction. Current and future periods absorb the revised estimate. Now let us move to the allowance for doubtful accounts. Metro Home Goods is a fictional wholesale distributor. A regional downturn affects customer credit quality, and updated aging analysis shows that the allowance needs to increase. The existing allowance is $12,000, but the target allowance based on new credit evidence is $30,000. This is not a multi year depreciation allocation, it is a current period estimate update. The company now believes more receivables may be uncollectible, so it must bring the allowance to the revised target amount in the current period. The allowance adjustment is straightforward. The target allowance is $30,000. The existing allowance is $12,000. The required increase is $18,000. The journal entry is debit bad debt expense $18,000 and credit allowance for doubtful accounts $18,000. This hits the current period only. No prior statement is reopened because the change is based on updated credit quality evidence. This example also shows why estimate changes can affect income immediately. Prospective does not mean ignore the change. It means record the change in the proper current and future periods, not in old periods. Warranty estimates work in the same logic. Harbor Appliances, a fictional company, originally accrued warranty costs using a 1.5% expected failure rate. Later, post sale data shows failures running closer to 3% because of a component supply issue discovered after production. The warranty liability must increase. But because the component issue was not known when the original warranty estimate was made, this is an estimate change, not an error. The company records additional warranty expense in the current period and updates the liability. The estimate doubles, but the classification does not become an error merely because the change is large. Inventory obsolescence is another strong example. Quartz Foods produces shelf stable food products. A new competitor enters the market with a cheaper substitute. Demand falls, and management concludes that certain slow moving inventory lines will recover less than previously expected. Under inventory guidance, inventory may need to be written down when net realizable value is below carrying cost. The net realizable value is an estimate, and when current market evidence changes, the estimate must be updated. The write down is recorded in the current period as cost of goods sold or a separate loss depending on presentation. There is no retrospective effect. Documentation matters because estimate changes can be abused if they are not supported. A good accounting file should answer four questions. What changed? Identify the specific estimate and quantify the old and new amounts. When was it discovered? Timing decides which period absorbs the adjustment. What evidence supports the change? Attach inspection reports, credit data, market analysis, actuarial reports, or other source documents. Why now? Explain why the revised estimate was not supportable earlier. This final question is especially important because it separates a legitimate estimate change from a possible error or earnings management concern. Good documentation protects both the numbers and the accountant. This is the no restatement zone. Estimate changes do not rewrite history. Prior period financial statements are not adjusted as if the revised estimate had always been known. Opening retained earnings is not restated. Prior audited statements remain unchanged. There is also no pro forma recast showing how prior years would have looked under the new estimate. If someone says the old estimate turned out wrong, so let us restate last year, slow down. That instinct may feel natural, but under ASC 250, it is usually incorrect. Restatement belongs to error correction, not normal estimate changes based on new information. Sometimes an estimate change and a principal change are so linked that they cannot be separated. ASC 250 recognizes this hybrid category. The treatment is prospective, like an estimate change, because the change is driven by new information about future benefits or patterns. But there is also a preferability requirement, like a principal change, because the method component is changing. This is a nuanced area. The accountant must not simply say it is an estimate, so no further analysis. If the method changes too, management must support why the new method is preferable for financial reporting. Depreciation method changes often create this hybrid issue. Suppose an asset was originally depreciated on a straight line basis because benefits were expected to be even across the asset's life. After production data develops, management sees that the asset generates significantly more economic benefit in early years and sharply less later. An accelerated method may now better match the pattern of benefit consumption. The change is treated prospectively, but preferability support is still required. The company should document why the new method better represents the asset's economics. A different number alone is not a good reason. A better representation of economic benefit is the stronger reason. Now, watch out for the planned switch trap. Some accelerated depreciation methods naturally switch to straight line later when straight line produces a more appropriate remaining life allocation. If that switch was built into the original policy and documented from the start, executing the switch is not a new accounting change. It is simply following the original method. The critical question is whether the switch was planned and documented originally or whether management is deciding for the first time now. Not every movement from accelerated to straight line is an ASC 250 change. Check the original depreciation policy before classifying the event. Let us run a fast diagnosis drill. Take a moment with each scenario and apply the new information test. Updated credit bureau reports showing higher default rates after the prior year end point to an estimate change. An outdated aging schedule that excluded overdue receivables already existing at year end points to an error. An engineering inspection after 3 years showing a longer useful life points to an estimate change. A warranty accrual calculated at 2% when the written policy clearly required 4% points to an error. The pattern is clear. New evidence means estimate. Available facts ignored or misapplied means error. That completes our lesson on estimates and prospective treatment under ASC 250. Remember the four essential points. Estimates use new information, they are treated prospectively, prior periods are not restated, and errors come next. In the next episode, we will study prior period error corrections and restatements where the facts were available but were ignored, misused, or misapplied. If this video helped you, please like it, subscribe to the channel, support the channel, and share it with your colleagues who are studying or working with financial reporting. Your support helps the channel reach more serious accounting learners. I will see you in the next lesson.